Taxation of stock options for employees in Canada. Hi, my name is Allan Madan from Madan Chartered Accountant. In this video, I will explain what an employee stock option is and the different tax rules between Canadian-controlled private corporations and public companies for stock options. What is a stock option? An employee stock option is an arrangement where the employer gives an employee the right to buy shares in the company in which they work, usually at a discounted price specified by the employer. CCPCs. A CCPC is a company that's incorporated in Canada whose shares are owned by Canadian residents. By definition, a CCPC is a private company and is therefore not listed on a public stock exchange like the New York Stock Exchange or Toronto Stock Exchange. When your employer grants or gives a stock option to you, you do not have to include anything in your taxable income at that time. In other words, there is no tax consequence to you at the grant date. When you exercise a stock option, which means to purchase the shares in your employer, you must include a taxable benefit in your income. The taxable benefit is equal to the difference between the exercise price, that is the price that you paid to buy the shares, and the market value of the shares at the time of purchase. There is a special tax deferral for employees of CCPCs. The taxable benefit can be postponed to the date the shares are sold. This makes it easier for employees to pay tax because they will have cash available from the sale of the shares. Let's look at an example. Assume that the exercise price is $3 per share and the market value is $10 per share. When you exercise your right to buy the shares, a taxable benefit is realized for $7 a share, $10 minus $3. Remember, for employees of CCPCs, the taxable benefit is postponed until the shares are sold. If you meet one of these two conditions, you can claim a tax deduction equal to 1/2 of the taxable benefit, or $3.50 in this example. You have held the shares for at least 2 years after you purchased them. The exercise price is at least equal to the fair market value of the shares when they were granted to you. Public companies. Now let's move on to the taxation of stock options for public companies. On the date that you are granted or receive stock options in an employer that is a publicly listed company, you do not have a personal tax consequence. However, on the date that you purchase the shares, you will get a taxable benefit equal to the difference between the exercise price of the shares and the market value of the shares on that date. You cannot postpone the timing of this taxable benefit. Let's assume you work for Coca-Cola Canada and the fair market value of the shares today is $30 per share. According to the option agreement, you can exercise or buy the shares for $10 per share. Therefore, the taxable benefit that will be included in your income at the time of exercise is $20 per share. After buying the shares, you have two choices. A, you can immediately sell the shares, or B, you can hold on to them if you believe they will increase in value in the future. If you choose to hold on to the shares and sell them in the future for a profit, the profit made on the sale will be classified as a capital gain and will be subject to tax. Whether you sell the shares or hold on to them, taxes will be deducted from your paycheck to account for the taxable benefit you realized on the purchase of the shares. However, don't hold on to the shares for too long after purchasing them. This is because if the price of the stock drops, you're still liable for the taxable benefit realized on the purchase date. You can claim a tax deduction for half of the taxable benefit realized on the exercise or purchase date. To do so, all of these three conditions must be met. Number 1, you receive normal common shares upon exercise. Number 2, The exercise price is at least equal to the fair market value of the shares at the time the options were granted. Number 3, you deal at arm's length or on a third-party basis with your employer. For more tax tips, please click on the subscribe button and visit our website. Feel free to follow us on Twitter, Facebook, Instagram, and Google+. Don't forget to like, comment, and subscribe to our YouTube channel. See you soon, and thanks for watching.